Hello, my name is Douglas Hahn. I would like to talk about methods to calculate gross pay based on net pay. Some people are hesitant to use a net to gross payroll system like ours because they believe if they do, CRA will declare the amount above the net pay to be a taxable benefit, and they will get in trouble with the CRA. The truth is, if you use the wrong method, you will get in trouble with the CRA. But if you use the correct method, you will not. This video will describe right and wrong methods and why they are right or wrong. But first, a legal disclaimer. I am a programmer and a mathematician, not a tax lawyer or a tax consultant. I'm creating this video because some people tell me that I can usually explain matters clearly. If you want tax advice, I can't give it to you. Use this video to talk to your tax advisor, and they will confirm or deny my methods. Follow their advice, not mine. That done, let's delve into the problem. Mr. Slick wants to pay his employee a net pay of $5,000 a month. He says, we'll run the $5,000 through the CRA formulas, pay the employee $5,000, and any tax that results, the company will pay to the CRA. Can you hear the CRA sirens going off? We want to explain why this is wrong, but in order to do that, I'm going to use a simplified example. The CRA method for calculating tax using a computer is called T4127. It's complicated, and if I start with the complicated example, the explanation may not be clear. So to start, I'm going to simplify the tax system, just to make the explanation easier. After I've worked through this example, I will use a real-life example. But for now, we're going to simplify our tax calculations. Let's say that in our example, the tax rate for everyone is 30%. For now, we'll forget that there is CPP, EI, and income tax, and we're going to lump everything into one easy tax rate. Mr. Slick wants to pay the employee $5,000. He calculates that the tax is $5,000 times 0.3 equals $1,500. He pays $5,000 to the employee and $1,500 to the tax department. Mr. Wright, a patient and thoughtful person from the tax department, calls Mr. Slick and says, "You can't do that. Let me explain why." If you pay the tax for the employee that way, you must treat the tax amount as taxable income or a taxable benefit. So you need to pay the tax on the $1,500. Mr. Slick replies, "Okay, if I pay 30% on the $1,500, let's see, that would be $450. Will that make it right?" Mr. Wright replies, "You'll be closer, but then you must also pay tax on the $450. "Wait a minute," Mr. Slick responds. "I see a loop happening here. When is this going to end?" "You're right," said Mr. Wright. "It is a loop, and you must keep working it out until you get to zero." I call this method the additional taxable income method. We'll start with the original $5,000 and calculate the tax on that. Then we'll calculate the tax on the $1,500, and so on. And we'll keep on going until we get to an additional taxable income of 0. If we add up all the tax, we come to a total tax of $2,142.87. So what did I do wrong? Mr. Slick says, exasperated. I can explain, said Mr. Wright. You multiplied net pay times the tax rate to get the tax. The correct formula is gross pay times the tax rate equals the tax amount. There's a big difference between the gross pay and the net pay. Let's look at the numbers again. Gross pay times tax rate equals tax amount. Also, the gross pay minus the tax amount equals the net pay. The correct gross pay is the net pay you wanted to pay the employee plus the tax that the employee has to pay. In your case, the net pay was $5,000. The tax amount we calculated using the additional taxable income method was $2,142.87. We multiply these amounts by our tax rate, 30%, and we get a tax amount of $2,142.86. In our second formula, just like above, your gross pay is equal to the net pay plus the tax amount. Then we subtract the tax amount and we get the net pay. In your case, the net pay you wanted to pay the employee was $5,000. The tax amount calculated using the additional taxable income method is $2,142.87. Then we subtract the tax amount we calculated above. And we get $5,000.01. Okay, we're a cent out, but that can happen because of rounding. Because we have a simple tax rate, we can calculate the gross pay using another method, the reverse math method. We'll start with our formula. Gross pay times tax rate equals tax amount. And we'll also use the formula gross pay minus tax amount equals net pay. Hold on here because we're going to use some high school math to put these two equations together and solve for gross pay. Both equations have a tax amount in them. We can substitute these variables so we work with only one equation. With this one equation, we have two instances of gross pay on the left side of the equation, so we can associate them and change the formula. Remember that we are trying to solve for gross pay, so we want to get it all by itself. We can do that by dividing both sides by 1 minus the tax rate, which will leave gross pay all by itself. We've solved the formula for gross pay. Now Mr. Slick can plug in the net pay, which he knows, and plug in the tax rate, which he also knows, and solve for gross pay. 30% is the same as 0.3. And the math calculates the gross pay as $7,142.86. From this, we can calculate the tax. And the net pay. So we have two methods now, that come to basically the same answer. There is also a third method I call the bracketed estimate method. In this method, we use a gross pay estimate that we know is too low and a gross pay estimate that we know is too high. Once we have a low number and a high number, we have bracketed the correct results, and it's just a matter of narrowing down our estimates until we get the right answer. We start with a low estimate of $5,000 for gross pay. We know that if we start with the same gross pay as the net pay we're targeting, we're sure that there will be tax on the amount. So there was no way that we are going to get a net pay of $5,000. And as expected, it is too low. Next, we try a gross pay that we know is too high. For our simplified example, our tax rate is 30%. So if we estimate a gross pay of 3 times the net pay, we are sure that we are going to get a net pay that is too high. And it is too high. Now we have our brackets, and we can estimate halfway in between the two estimates. That turns out to be too high as well. We'll eliminate the top numbers because we have a high estimate that is closer to the target. We'll move the middle numbers to the top. And we'll try gross pay halfway between the two estimates. Still too high. Let's follow the same process. Now we're too low. We'll do the same procedure, but this time we'll eliminate the numbers at the bottom row and estimate in between again. We're getting closer. Our high estimate is about $4 above, and our low estimate is about $10 below. We're getting closer. We're very close, 6 cents above and 15 cents below. And there's our match. Gross pay is $7,142.86. So let's compare the three methods. Using the additional taxable income method, our gross pay is $7,142.87. Using the reverse math method, our gross pay is $7,142.86. And using the bracketed estimate method, our gross pay is $7,142.86. Three methods that agree to within 1 cent. Of course, this is using a simplified example. We all know that in Canada, the CRA tax calculations are not as simple as 30% of income. There's income tax that varies by province, there's CPP, and there's EI. There are different levels of taxation depending on your income amounts. And then there are a few exceptions thrown in as well. Let's look at the methods we described in the simplified example and see if we can apply those methods to real life. First, the reverse math method. The January 1st, 2017 edition of T4127 tax calculations from CRA is 37 pages long. That's not all formulas, but there are a lot of calculations. For me, it's too complicated to reverse the calculations. The next method is the additional taxable income method. This is a possibility, but we need to be careful because the tax for the dollar at the bottom of the scale is not the same as the tax on the dollar at the top of the scale. When our tax formula was 30%, that applied to all dollars. But as all good payroll people understand, the first dollar that you earn will have very little tax on it. But the dollar on top of a $10,000 monthly pay will be taxed significantly more. As long as we keep this in mind, it is possible to use the additional taxable income method. The third method is the bracketed estimate method. And I believe that this method is the easiest method to use. So let's take a real-life example. Here's our payroll parameters. The employee has no dependents. TD1 deduction is $11,635. The employee lives in Alberta, and the TD1 for Alberta is $18,690. To make it simple, there's no RRSP, no registered pension plan, no alimony, no maintenance, no union dues, no additional CRA deductions, and no labor-sponsored venture capital credit. The employee does not live in a prescribed zone, and the employee is subject to both CPP and EI. More parameters. There are no taxable benefits and no deductions other than statutory deductions. The payroll is a monthly payroll, and the pay we will be processing is January 31st, 2017. There is no CPP or EI year to date. We are using the 2017 tax formulas. And finally, we want to determine the gross pay for $5,000 of net pay. The method we're going to use is the bracketed estimate method. Just like our simplified version, we are going to use a low estimate of $5,000 gross pay. We plug this amount into the tax formulas, and we get an estimate that is too low, as expected. Next, we're going to get a high estimate. When we test the CRA calculations, we find that the maximum tax rate across Canada is in Prince Edward Island. If your income is high enough, you will be taxed at 52%. Based on that, we know that if we triple the target amount, we are certain to get an estimate that is too high. We plug that into the CRA calculations and get, surprise, surprise, an estimate that is too high. But just like the calculations using the simplified version, we can narrow down our estimates until we get to our target net pay of $5,000. Too high as well. Move it up. Getting closer, but still too high. You can check all these numbers using your own payroll system. You just have to be prepared to run the numbers 20 or 25 times. We're getting closer. And we found our match. A gross pay of $6,974.56 will result in a net pay of $5,000. That would be a lot of work using a regular payroll system, a lot of tedious calculations. However, computers are really good at tedious calculations, which is why we wrote some payroll software to use this process. Here's what the employee screen looks like. Notice we've specified that our income amount is $5,000, and we have checked off a net checkbox, which indicates that the $5,000 is net income instead of gross income. It tells the software to use the bracketed estimate method to calculate the gross pay based on the target net income that we want. When we run the payroll program, a spreadsheet pops up that tells us what the gross income is, what the income tax, CPP, and EI are, and what the net pay is, our target amount. It's fast and simple. You don't have to do the bracketed estimate calculations. The software does it for you. But what if CRA comes back and says, because you calculated net to gross, the income tax, CPP, and EI that you are paying is a taxable benefit? Think of it this way. The employee's gross pay is $6,974.56. All of that is taxable income. The net pay of $5,000 is taxable income. The $1,530.07 income tax is taxable income. $330.80 of CPP is taxable income. $113.69 EI is taxable income. All of this is gross pay or taxable income. If CRA declares that the income tax, CPP, and EI are taxable benefits, and that amount is already taxable income, wouldn't that be double taxation? I mean, wouldn't they have to declare that $1,974.56, the amount above $5,000, would be both taxable income and taxable benefits? And if a certain amount is both taxable income and taxable benefits, wouldn't that be double taxation? Based on our information, CRA does not care how you get to your gross pay. It could be flat salary amount. It could be an hourly rate. It could be calculated based on shifts or pieces of work completed or any other method that you wish. The important part is that you start with gross pay in your tax calculations, not net pay. Yes, there are exceptions for bonuses and commission. However, for regular periodic payments, it doesn't matter how you get to your gross pay. As we said before, the important part is that you start with gross pay in your tax calculations, not net pay. And then subtract the income tax, CPP, and EI from that gross pay to get your net pay. Don't trust me on this. Run the full explanation by your tax lawyer or tax consultant. They're paid to give you good advice. You should trust them when it comes to tax matters, not programmers or mathematicians. But when they have confirmed our methods, please come back to us because we have the software that uses this method and we want to help you get your CRA calculations right the first time. Thank you.